This is Money Talk for Good Friday, 2026. Let's see what's happening. Your Milwaukee Brewers are on the road this week with Kansas City and Boston, and the Bucks are at Fiserv hosting the Celtics tonight and the Grizzlies on Easter Sunday. If you're looking for something to do on Saturday, it's Egg Day at the Milwaukee County Zoo. So grab your bunny ears, you can visit the animals and listen to Lisa, my wife, with the Dixieland jazz band called Razzmatazz. Yes, that's a shameless plug. Let's start with a little history. On this day in 1776, Harvard College awarded George Washington an honorary doctorate, which is good because his mom always wanted a doctor in the family. It was 53 years ago today the first cell phone call was made by Motorola engineer Martin Cooper. He called his rival at Bell Labs just to say, nah, 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 nah. And finally, 40 years ago today, the U.S. national debt hit $2 trillion. That's a 2 with 12 zeros behind it. But they weren't trying very hard. Today, the national debt is $36 trillion. Now we're talking. On the podcast today, we have our Rothschild, Adam Baley, Joel Driesing, and getting us started, here's Kyle Tetting.
Well, thanks, Max. We are recording this Good Friday podcast a week early, given the market holiday for Good Friday. Wanted to make sure we gave everyone a chance to have the day. And most importantly, I think a good reminder that there's a lot out there that we should be paying attention to. But since we're recording a little early, we wanted to take something that has been going on for a while and see if we couldn't have a bigger conversation about how it's evolved. And I'm thinking specifically of this tariff conversation that has shifted so drastically going back to Liberation Day, April of 2025, but even a little before that and some of the lead up to it. No doubt that there has been these massive swings, I think, in expectation for what it means for global trade. And yet here we stand a year after that, still, I think, trying to figure out what a lot of it means, trying to figure out where we are. Most recently, a ruling from the Supreme Court that essentially struck down the vast majority of the tariff policies that were put out there. It threw into question the $175 billion or so in tariff money that had been collected. It threw into question a lot of the trade deals that had already been negotiated but perhaps not signed yet. And so I think there is a lot still up in the air. But Adam, perhaps a good place to start is what we've learned about tariffs in the last year and what they really mean for investors.
Gosh, here we are a year past from Liberation Day, and it feels like we're still in the middle of the hurricane sometimes when it comes to how are we going to process all of this? Where do we go from here? A year ago, the president announced that we're going to be putting trade tariffs on so many of our trading partners. And it took the markets down very quickly, and the global markets with it, so much so that he had to issue a pause. And we gave ourselves some time to do some deals to the summer. Some deals happened, most didn't. And then we decided just here's what it's going to be. We're going to impart tariffs on countries whether they do deals or not. And that started kind of in the summer of 2025, and we really felt the full brunt of it come fall. Only for early this year, the Supreme Court to declare unconstitutional the tariffs and then moments later restart them in a different amount under a different section of the law. It has been mercurial. It has been all over the map. And I guess we still don't kind of know where we go from here because when the 150 days are up of these, what comes next on day 151? Ask me then and I'll tell you.
All right, I think what comes next has been the question, and for much of the last year, I think investors largely believed something was coming next, and it would probably be better than what had originally been announced. We joke about the taco trade or the Trump always chickens out trade, and I think unfair in part because that's always been the negotiating stance that this president has taken, right? That we're going to take a very hard line up front and we'll back off from there. But perhaps investors have still plenty to digest as it comes to that conversation.
Yeah, it's less a matter of the tariff conversation as having the biggest impact as it is to us adjusting to the style of the president and his impact on the markets. So a year ago in April, the markets got clobbered because of Liberation Day and this announcement of significantly higher tariffs that then economists were suggesting was going to cause a recession. The stock market historically, then dropped over 10%. We had a correction within the month of April. But then we got it all back by the end of the month because of, as you suggest, the taco trade. He changed his mind. He reduced the amount that he was going to be imposing of tariffs. A year later, we've got this, and we're not sure exactly where it's going to be as of Good Friday, but we've got this conflict in the Middle East that's resulted in higher oil prices, which quite frankly would dampen the market even more than the tariffs, which we've now adjusted to. So I think the lesson over the past year is more a lesson of how we should or shouldn't react to events as they happen, and how we should be aware that something can always change. So I'm not as concerned about tariffs anymore because we've seen that countries and companies are going to adapt to what they have to adapt to. In the context of the current conflict, again, we haven't lost as much as quickly. And however, if this continues, we could have other consequences. Again, higher oil prices, higher inflation, other things to contend with. So I think the lesson is pay attention, know what's going on, but don't overreact to it because this president is focused on the markets. And if something has enough of a negative impact, that's what we learned from Liberation Day, he and his administration will adjust. So that's about the only confidence I have in these policies, which if you throw them all together, higher tariffs, higher oil prices, bigger deficits mean higher costs and lower consumer confidence, less spending, possible, declines in the market over the long haul. I don't see that right now. I don't feel that right now, but that's what you have to be conscious of.
And Art, there's some evidence that consumers, that investors, that companies actually are doing like you're doing, and they're just they're paying attention, but they're not reacting as much. I mean, you could argue that there was overreaction last April when these tariffs were first announced, but the latest surveys that I see, I'm thinking of the Institute for Supply Management in particular, where they talk to purchase managers, and they're just sort of saying, yeah, we don't really know what's going to happen with these tariffs, but we're just sort of building business models where we can be more flexible and just figure that those costs are going to be somewhat higher somewhere.
And this is one of the things that's been so difficult for the business communities, the CEOs, CFOs, purchasing managers, you name it. Businesses need to know what their taxes and tariffs are going to be when they do business around the globe. They have to, because you have to have a business plan. You can't run a business on a guess. It doesn't work that way, right? You have to have a business plan. And with the ever-changing taxes and tariffs for corporations, it is making it very difficult to plan. And it also is causing some businesses to stand pat because, what if we don't know? Are we going to make that capital expenditure? Are we going to build that new production line? Are we going to hire that third shift? If your answer is, I don't know, that can cause businesses to take a step back and say, you know what, we're just going to stand and wait for more clarity.
But if anything, this shows how resilient our economy and the global economy is. After the Liberation Day declines or the Liberation Month declines, we made 18% on the S&P last year. So despite the fact that the market can react negatively to uncertainty, despite the fact that businesses didn't know what to do, because they don't know what the policies are going to be, they were, again, resilient enough to still be profitable, and consumers were still spending. And furthermore, these are self-inflicted wounds. If the president keeps coming up with things that are going to pull the rug out from under businesses and consumers, you can expect that periodically we're going to get declines. But again, this economy is strong enough, Kyle, as you suggested over time, we've overcome these difficulties. And so I'm still pretty confident that over time we'll do well, despite whatever drag is ultimately put on the economy by whatever successor to the tariffs that were struck down might put in place.
As of March 27th, the S&P 500 3.66% higher than it was prior to the tariff sell-off, the peak prior to the tariff sell-off. And so in the span of a year, the S&P, including dividends, you put it at another 1.5% there, you're up almost 5%, maybe a little more, simply by allowing companies, I think, to do what they do best, which is adapt. And I think it speaks much less to the political climate, much less to what are our politicians doing or not doing, and candidly, a lot of it has been not doing, and a lot more to businesses' ability to find ways to make money. And what's most interesting to me is that where we have been clear that trade needs to change, and especially when it comes to China, for example, well, businesses have seen the writing on the wall that even if things are going to get better than what was proposed in Europe or Mexico and Canada, China's on the list, and that's going to be a problem. And we've seen this massive shift away, businesses just not doing as much of their imports, as much of their inputs from China anymore as they used to. And we're at the lowest level for goods coming from China relative to our total imports that we've seen since going all the way back to 2001. And I think that speaks to just how much has happened to change supply chains, consumer preferences. When you look at what it costs now to bring something in from China compared to getting it from our neighbor to the north or our neighbor to the south, yeah, maybe it's still more expensive than it was, but the administration, and by the way, not just this administration, but the previous administration has made clear, well, maybe we were being taken advantage of. Maybe things did need to change there. And what impresses me again is that businesses have been so able to adapt and still see earnings growth. And then I would add that we now, in the span of the next 4 or 5 months, will have another negotiation take place between the U.S., Canada, and Mexico. You've got our own Senator Tammy Baldwin, as well as many other both Democratic and Republican senators in Congress, speaking specifically about some of the trade that needs to be adjusted with respect to those countries. And I think for good reason, we are going to see a lot more change than what we saw the last year, but it's not all going to be for the worse. And most importantly, I think businesses have proven that they can adapt.
Yeah, not everything has been for the worse. One of the, I guess, maybe unintended consequences that I've just found so interesting this past year is China has a record trade surplus. They have record shipments. And even though we're not importing a lot of stuff from China, China is finding buyers across the planet for their goods and services. You asked me a year ago, would that have happened? I would have said probably not, but here we are a year later. And it's interesting to see that China's at a record trade surplus and record shipments for their goods.
And I should point out that while the tariffs themselves weren't exclusively used to punish China, that there were many other countries that were in the crosshairs, China seems to be the one that we keep coming back to. And the reality is that China does have certain things we need. There are rare earths. There are all kinds of things that China can produce either more cheaply, more effectively, or just that they're the only ones that have. And we are going to have to be a trade partner with them for certain things in some form or fashion. And so it is important that we get resolution. But Adam, you absolutely hit the nail on the head. Not only were we able to back off of our reliance on China, but China was able to continue to excel because just like our businesses, just like our people are able to adapt, I think it's clear that China has found new trade partners. And rightfully so, they've got products they want to get to market. They're finding places to get them. Joel, I think the big question over the last year with respect to a lot of the economic data that we look at is how much it really has been impacted by some of these tariff conversations. We had no shortage of conversations on these podcasts over the last year that looked at things you mentioned earlier, like the consumer confidence numbers, where tariffs certainly weighed heavily. Any particular areas that really stood out to you as we look at the last year or so of economic data and go, yeah, tariffs weighed here?
You know, it's multiple factors, so you can't put it just on tariffs. But one of the explanations for dealing with the tariffs, as you mentioned before, was to bring more manufacturing to the United States. I was just looking at numbers on construction spending, and manufacturing construction spending peaked in mid-2024, and since then it's gone down more than it went down during the Great Recession. And it's not for as long a period yet, but it's had that plummet. So there are, as Adam pointed out, maybe unintended consequences, and maybe there are other factors in there that are giving manufacturers a pause in their expansions and their building. But that's one thing that I've looked at, and I know that manufacturing employment hasn't increased in the U.S. There's an argument to be made that maybe some of that is being made up for with artificial intelligence. We've got this business cycle that we're in right now so far has been more productive than in the last one that included the Great Recession. But there are other things to look at just besides the prices in general and what's going on.
Well, and I think that this productivity cycle we're in certainly points to the fact that the labor is not there the way it used to be, that we don't have the people. And so the productivity was necessary. When you consider, I think that one of the aims of these tariffs have been to bring back manufacturing, or at least critical manufacturing, pharmaceuticals, shipbuilding, critical steel, those kinds of things. Well, okay, one of the questions I had early on was, how do you get enough people to do that work, especially enough skilled people to do that work at a time in which we haven't done it for decades, at a time in which, oh, by the way, our population has continued to age, and in which many of our best and brightest from the time in which we did that are now either out of the workforce or will be soon. And I think the answer has been that the only solution was to get more productive and to have technology solve a lot of those problems.
In the latest quarter that the Bureau of Labor Statistics measured, productivity went up because output went up, even though the number of hours that workers have worked went down.
And I would add that if manufacturing boosted by that productivity growth is really where we are headed long term, it also potentially speaks to some pretty meaningful growth opportunity. In order to feed that manufacturing capacity, you need $1 trillion to $1.5 trillion in energy infrastructure. You need all of the property, plant, and equipment that's necessary. Short term, tariffs weigh on that conversation, because if you don't know what it's going to cost to import that machine, if you don't know what it's going to cost long term in terms of how long am I actually going to be able to keep this production line humming, I think there's some bigger questions about whether or not you're willing to commit to it. But realistically, if we are going to see some of the benefits we've been aiming for, some of the early aims of these tax and tariff, that, well, okay, it's going to come with some economic growth along the way. With that, we enjoy doing the program for you. We'll talk to you again next week.